Let's run an experiment. Set the time to the middle of 2026. At this moment, you are reviewing your quarterly portfolio report. If you stuck to your allocation logic from 2024, your balance sheet is likely a wreck. You see those once arrogant tech giants, their stock prices having undergone violent mean reversion. You see your net asset value curve completely decoupled from the broad market index. You feel angry. You feel confused. You ask yourself, why, in this so-called rate cut cycle, did I become the biggest loser? Back to December 2025. A critical tipping point that looks like a carnival, but is actually a crisis. For most retail investors, right now, late 2025 feels like the pinnacle of US financial history. But I must be frank with you. This is a dangerous illusion. To survive 2026, we must first dissect this massive dual-track scam of the past 12 months. First layer of regression, the masked collapse of market breadth. Let's peel back the skin of the index. In the past year, if you simply bought the S&P 500 ETF, you were actually betting on a statistical lie. Although the index is rising, if we run an attribution analysis, you will find that the so-called bull market is a hollow shell supported entirely by those 6 to 7 tech giants, the Magnificent Seven. This is not just a concentration risk issue. It is a mathematical trap. These trillion-dollar giants have weights so large they distort reality. Mathematically, a 1% rise in them is enough to wipe out the drag caused by a 1% fall in the remaining 490-plus components of the past 3 years, 2023 to 2025. These 3 years were an incredibly rare period of low difficulty investing. When retail investors buy S&P 500 ETFs, these funds are not engaging in value discovery. They don't care about corporate cash flow. They don't care about management quality. They simply build positions mechanically based on market cap weighting. This created a self-reinforcing momentum loop. The larger the market cap, the more passive liquidity it absorbs. The higher the price is pushed, the heavier the weight in the index, and the stronger the buying in the next round. This manufactured a fatal illusion. Being long tech giants is risk-free. But standing here at the time node of late 2025, I must issue you a warning. This cycle is facing the sanctions of the laws of physics. The power of mean reversion is irresistible. The undercurrents of institutional capital. If retail exhaustion isn't enough to wake you up, then pay attention to the moves of the smart money. If you have access to institutional dark pool trading data, you will discover a shocking divergence. While retail investors are still frantically chasing call options in the derivatives market, trying to catch the tail of the bull market, Wall Street's top fund managers are executing an epic position adjustment. What are we doing? We are rapidly deleveraging and significantly lowering portfolio beta. This is not a complete liquidation, because benchmark restrictions require us to stay in the game. However, capital is retreating from those crowded, high-valuation tech sectors. This is why recently, even when certain tech companies posted earnings that beat expectations, their stock prices still suffered sell-offs. This is the classic sell-into-strength pattern. So, where is this withdrawn capital going? Liquidity is pouring into those valuation depressions that the market has neglected for 3 whole years. Money is flowing into rate-sensitive assets, flowing into traditional industries that possess strong cash flows but lack the AI premium. This is absolutely not just a tactical rebalancing. This is a strategic bet on the macro paradigm shift of 2026. Wall Street elites know very well that the macro trinity that supported the bull market of the past 3 years, high inflation, high nominal growth, high interest rates, is about to disintegrate completely. Replacing it will be a brand new cycle: low growth, rate cuts, and high volatility. And the starting point of this new cycle, the Federal Reserve will hold its final FOMC meeting of the year. Futures market pricing shows that Wall Street has priced in rate cut expectations at 100%. This is the most deceptive moment in the entire story. For junior investors, their linear thinking goes like this: rate cuts equal lower cost of capital, which equals rising stocks. If you enter the market of December 2025 with this simplified thinking, you are standing on the edge of a cliff. This misconception has repeatedly destroyed the wealth accumulation of the middle class in past cycles. Observe the past 3 major rate cut cycles, 2000, 2007, and 2019. You will find a spine-chilling pattern. The starting point of a rate cut cycle is usually not the bottom of the market, but the confirmation of the top or the final bull trap before the crash. 2000. Rate cuts landed, followed immediately by the bursting of the dot-com bubble. 2007. Rate cuts began, immediately triggering the collapse of real estate credit. The reason is very simple. Once the central bank starts cutting rates, it is tantamount to an official endorsement of the fact that the economy is declining. From that moment on, the market's trading logic switches instantly. We switch from inflation hedging mode to recession pricing mode. The market will no longer focus on how much rates have dropped, but will start to panic. To what low level will corporate earnings per share, EPS, correct? This is the classic buy the rumor, sell the fact. The rise over the past few months has completely overdrawn the expectation of rate cuts. The moment the rate cut actually lands next week is when the good news is exhausted the moment the smart money exits. The lag effect and the refinancing wall of 2026. I know you will rebut. But doesn't lowering interest rates reduce the debt pressure on companies? This is a typical time mismatch fallacy. You are ignoring the most terrifying variable in monetary policy: long and variable lags. Even if the Fed starts cutting rates in late 2025, the real economy will still have to digest the tightening effects brought by the high interest rates of 2023 to 2024 for a full year ahead. If you continue to use the logic of 2024 to operate in the market of 2026, the result is certain. You will become the bag holder for institutional distribution at the highs, and in the subsequent asset rotation, you will watch undervalued assets explode while the high-priced chips in your hand shrink significantly. The great asset repricing shuffle. Since we have seen through the macro shift behind the rate cuts, how exactly will the script of 2026 play out? Rate cuts do not mean the market will collapse across the board. They represent a complete transfer of capital preference. A $1 trillion asset shuffle is taking place. In the past high-interest era, 2023 to 2025, the logic was simple. Cash is king. Capital either flooded into money market funds to earn a 5% risk-free return or huddled together in cash-rich giants like Apple and Google. Because these giants don't need to borrow and can even earn interest income through massive cash reserves. This is the fundamental logic of large caps up, small caps down. However, with the opening of the rate cut cycle on December 10th, this logic will flip 180 degrees. First, declining risk-free rates mean the attractiveness of cash drops significantly. The $6 trillion currently locked in money market funds will be forced to flow out to find new yield. Where will this money go? It will flow to those sectors that have been suppressed by high rates for 3 whole years and whose valuations are at historical lows. These sectors will show the greatest price elasticity in 2026. There are 3 core directions here. First is the Russell 2000 index. These small cap companies usually have high leverage ratios and a large proportion of floating rate debt. Rate cuts will directly improve their profit and loss statements. Mathematically, for every 25 basis point drop in rates, their net profit could rebound by 10%. In finance, this is called high convexity payoff. Second is the biotech sector. This is an industry extremely dependent on external financing for R&D. The rate hike cycle was their darkest hour. But once the rate cut cycle opens, lower capital costs will restart M&A activity. Large pharma companies will use their cash to frantically acquire those undervalued innovative drug companies. Real alpha returns for 2026 will be born here. Third is real estate and utilities. They are typical bond proxies. When treasury yields decline, these assets that can provide stable dividend yields will become extremely attractive, becoming a safe haven for defensive capital. The reversal of the dollar cycle and the truth about AI. Beyond sector rotation, we must focus on the currency itself. Do not ignore the direction of the dollar index. Over the past few years, a strong dollar was like a vacuum cleaner, sucking up global liquidity. But with the Fed cutting rates If the actions of European and Japanese central banks lag, the narrowing of interest rate spreads is inevitable. The logic is very clear. The dollar will enter a weak cycle. For investors holding only dollar assets, this is a hidden risk of purchasing power shrinkage. But for global allocators, this is a huge opportunity. Gold, copper, and crude oil will face tailwinds. Emerging markets rebound. Capital spillover will flow back to valuation depressions, including core assets in East Asia. For the past decade, the darlings of the US stock market were CRM, marketing software, and other SaaS companies. Their business model is charging per seat. But what is the core logic of AI? It is efficiency improvement and cost reduction. It is reducing headcount. This directly attacks the SaaS pricing model. So, who are the winners of the AI second half? For the past 3 years, NVIDIA was the absolute king. The logic was, the whole world is building infrastructure. But in late 2025, the logic is shifting. After large model training passes the passing grade, the center of gravity will shift to inference, that is, AI application landing, content generation, and edge computing. This means hardware demand will shift from extreme performance to high cost effectiveness and ubiquity. We predict that in 2026, market volatility will shift to a significantly higher center. The one-way beta market has ended. To capture the excess returns of sector rotation while preserving capital, I strongly suggest adopting a dumbbell strategy. One end extremely defensive to lock in certainty, the other end extremely offensive to bet on high elasticity. Part 1. 40% defense building a yield moat. This part aims to lower portfolio volatility and provide cash flow. The early stages of rate cuts are often accompanied by shadows of economic slowdown. Regardless of how tech stocks fluctuate, basic livelihood needs are rigid. Allocation direction. Focus on utilities, consumer staples, and large pharma. Logic. They possess stable free cash flow and high dividend yields. When growth stocks face valuation compression, these bond-like stocks provide a safety cushion. Our principle is, do not seek to double capital gains, only seek to beat inflation and control drawdowns. Part 2. 40% offense sniping the new macro cycle. This part is responsible for generating alpha. You need to discard the lazy thinking of buying market cap-weighted indices, retreat from crowded tech giants, and precisely allocate to depressions benefiting from rate cuts and hard tech. Allocation direction A. Russell 2000 Index. This is the main receiver of liquidity rotation. Rate cuts will repair balance sheets, bringing a Davis double play. Allocation direction B. Energy, infrastructure, and edge side chips. These are the true winners of the AI second half. Operating principle. Build positions in batches on the left side, buy into panic pullbacks, strictly forbid chasing highs. Part 3. 20% hedging insurance and dry powder. Never be fully invested in risk assets. This 20% determines your survival rate in extreme market conditions. 10%. Gold hard assets used to hedge against dollar credit system risk. If rate cuts trigger secondary inflation, analogous to the 1,970 seconds, gold is the ultimate anchor of purchasing power. 10% cash. USD. Short-term bills. Wall Street calls this dry powder. 2026 will inevitably see black swan-style liquidity shocks. When the masses panic sell because they are trapped in full positions, this is your only ammunition to loot premium chips at floor prices. December 2025 is the watershed of the cycle. Looking back at the past 3 years, many people's success was actually just luck masking, strategic laziness. But in the upcoming 2026, the market will brutally punish those blind followers who lack logic and reward the minority who perceive macro trends and strictly execute discipline. Investing is not a sprint competing on speed, but a marathon competing on survival duration. In this high-noise market, please maintain independent thinking and stick to trading discipline. This is your macro lesson from 2026. Good luck!